Hi there, this is Tyler Braun with the Tranel Financial Group. I'm one of our senior financial advisors, and I'm here to talk about restricted stock units. So many of the clients that I work with, especially those that are at the manager or executive type level, they run into a term called RSUs. And they say, what is an RSU? And an RSU is just an acronym for restricted stock unit. And there's a lot of questions that come with this. So during this presentation, I want to keep it fairly short. But really, I want to talk about some of the things that come up, right? The first question I get is, what is a restricted stock unit? Number two, how does it work? And then number three, are there any tips or tricks or strategies or anything that you should take note of? And that's what we're going to cover. So we're going to talk about what they are, how they work, and then really what you should take note of, just a few strategies to help implement a plan for you. So let's dive into it here. So a restricted stock unit, what is it? All right, it's a form of compensation from your employer or your company, and it's typically in company shares, and it allows you to defer that income over a period of time, right? So if you're receiving, let's say 1,000 shares of restricted stock unit, and let's say the vesting period is 3 years, it allows the company and yourself to defer that income over a 3-year period. So it's basically a way to help remunerate higher income individuals rather than just a salary or a bonus, but also take part in the company growth as the stock appreciates in value. So gives you a little skin in the game, gives you a little buy-in in terms of long-term growth in the company. The most common question I get is, how do they work? They understand, when I say they, most people, most of my clients understand that when they receive this is an additional form of compensation, and they know it's a good thing, but just how does it work? What is it, right? So as you're acquiring these shares of stock, right, they're not actually yours until they vest. So you'll see an agreement that might come up in your contract, let's say, and you can see an example here below. Let's say you receive 1,000 shares of the ABC company, and they're going to vest over a 3-year period. And then each year going forward, you're going to continue to receive 1,000 shares of new RSUs, and those will continue to vest over a 3-year period. So most people think when they get this 1,000 shares of restricted stock units that, oh, I've got my 1,000 shares of stock units, I have 1,000 shares of the company stock. It's not the case, right? If they're vesting in this example, and each company has their own vesting period. So this is not across the board, but let's say the ABC company here has a 3-year vesting period, right? What they're saying is basically you're getting a third of those 1,000 shares that you received each year for a total of 3 years. So after year one, you've actually vested 333 shares in that example, right? After year two, you get your next 333, and then year three, the exact same that we talked about. So let's just put that as an example and share that with you so we can take a look at it here. So if this were ABC company and we were explaining how this works, after year one, if you received 1,000 shares at the beginning of the year, after that 1-year time period, you would have vested 1/3 of those shares, right? If it's a 3-year vesting cycle, right? 1 divided by 3 is a third. You would have vested 1/3 of the 1,000 shares. So the total shares you received in year one was 1,000 shares. You vested 1/3 of that 1,000 for a total shares vested of 333. After year two, right? Each year you're going to receive, let me fix that here, right? I'm a numbers person, not a spelling person. So ultimately, you're going to receive an additional 1,000 shares, just like we showed before. So you received 1,000 shares in year one. You vested 1/3 of those shares for 333 total. Year two, you're receiving another 1,000 shares of restricted stock units, but now you're actually vesting 667 shares, right? So when we look at this, a third, you're vesting your second portion, right? Because you're in year two, this vests a third, a third, a third. So if this paid out over 3 years, you'd get 3 rounds of 333 shares. This second round is vesting, so you're receiving that portion, plus you're receiving an additional portion of your first round of year 2, because this would vest a third, a third, a third. When we get into year 3, well, let me take a step back here. So the total shares you would have received from year 1 and year 2 totals 2,000 shares. And the total number of shares vested now that you're in year 2 is 667 in that example, right? Your second third of year 1 and your first third of year 2. When we look down through, and let's go to year 3. Anytime after year 3, the beautiful part about this system is every year going forward, you're vesting a full 3/3 or a full 1,000 shares. So let's look at it here. You're in year 3, and what you'll vest is your final third of year 1, your second third of year 2, and then your first third of year 3. You're vesting a full 333 shares in this example for each of the years that you've had in the plan, and that totals 1,000 shares that'll be vested. And the beautiful part about it, total shares received, you receive an additional 1,000 for that year. So now you have total shares received, 3,000. Total shares vested equal 1,000 in that example. But every year thereafter, you're going to continue to receive 1,000 shares. So even though we're in year 4, all of your first year plan shares are fully vested, meaning they're done, right? You fully vest them, they're your shares now at this point. Year 2, you'd be in your final third. Year 3, you'd be in your second third. In year 4, you'd be in your first third. So you received another 1,000, and every year after year 3 in this example, you're fully vesting 1,000 shares per year. It's a snowball effect. You know, it's how the rich get richer. This is happening in the background, and you have to do nothing. It's just accumulating for you. So it's a beautiful, beautiful system that's put into place. And ultimately, when we look at that, it's something that you need to plan for. So in terms of looking at the plan and saying, you know, what strategies or things do I need to take note about, right? Number one, when an RSU vests, that is going to create what's called a cost basis, okay? So as that RSU vests, so in year 1 or after year 1, excuse me, as that 333 shares vest in the example that I shared with you, that's a taxable event. So that simply means that you're going to be taxed as a form of income on those 333 shares that you're receiving, okay? That's going to set a cost basis for you, meaning what you acquired them for. How much did I pay to receive these 333 shares? Many companies, when they're looking at that and they're vesting those, automatically will withhold a certain percentage of the shares as your tax withholding. So for example's sake, let's say that they're withholding a 25% rate. If you received 100 shares of ABC company, you would only net 75 shares after the taxes were withheld, right? They're going to withhold taxes from that. What that does is it sets that basis for you, and then going forward, that's all after tax money. I'm going to put a disclaimer in there because a lot of people ask, well, you know, I never saw anything that occurred in the past that said these were taxed. It's going to be reported directly on your W-2 if you're employed. So if you're still working, it's going to show directly on the W-2 as earned income because that's what it's being taxed as. Otherwise, you'd receive a 1099 if you were no longer with the company or retired. In terms of just assessing some different strategies out there, the first term that you need to educate yourself with is just short-term capital gains versus long-term capital gains. So they sound the same, but are treated completely differently. In terms of short-term capital gains, right? Short-term capital gains equal ordinary income. Long-term capital gains right? A general rule is a 15% federal rate. Now, this is an assumption. There's different things that go into this, state tax, additional taxation that could apply, but we're just going to use a 15% federal rate as an example for this plan. So let's run this. This just will illustrate the difference of a short-term gain versus a long-term gain for selling some company stock. So if we decided we wanted to sell 1,000 shares of ABC stock at $100 per share, and we sat down together, and the first question I'm going to ask is, what's your cost basis? You'll bring in your statement. It's listed right on your statement. And let's say the cost basis, which is a fancy term for how much did I pay to get those shares, is $75 per share. And when you go to sell the 1,000, you're selling it for $100 per share. So that's a $25 per share gain. Okay, if you're selling 1,000 shares at $25, a $25 per share gain, that's a $25,000 total gain for the account. That's what you're paying taxes on, the total gain from that sale. Short-term capital gain is if you're selling a stock and you have not held it for longer than 1 year. That's the key phrase, right? A short-term capital gain would mean that if you had this company, these shares, these 1,000 shares of ABC stock that you acquired at $75 per share, and it just went crazy. The performance did great in the first year, and it's worth $100 per share, and you said, I wanted to sell it, right? And you held it for less than 1 year, you're going to pay ordinary income on that. So whatever your total tax bracket, right, your marginal rate would be, your effective rate would be in terms of taxes, whatever your tax rate is, let's assume 30%, because you're an executive type individual or a manager type individual, that is what you will pay as your tax rate. So if you had $25,000 in gains at a 30% tax rate, you're going to owe Uncle Sam approximately $7,500 in taxes. Long-term gains are assets that you've held for longer than 1 year and 1 day. So anything you've held over 1 year, right, is a capital gains rate, and it's long-term. Right now, the federal rate is approximately 15%. So like I said, we're using that as an assumption for this plan. So at a 15% rate, if we took that same $25,000 and we applied the 15% long-term capital gain rate, that's equivalent to $3,750 in taxes owed. So where I see a lot of people make mistakes when they're looking at this, they don't have a plan in place. So what they're doing is they're receiving these shares and they're liquidating them. This might have been accruing in the background for the last 5, 10, 15 years for some executives, and they get to a point where they want to liquidate these, and they're pushing the button. They're saying, you know what, these came out, I want to sell them. And they're saying, well, I'm going to hold the ones I've held for a long time, and I'm going to sell the ones that I just received in the past 4 months because the stock's doing well. That's an okay strategy for some, but for others, you have to look at the tax consequences behind it, because literally in this example, you'd be paying twice the taxation just to receive those shares. So you need to pay attention to long-term versus short-term capital gains. That's number one. Number two, most people, when they receive these, they receive them as a form of compensation or bonus and don't think about them again. So they accrue in the background for years and years, which is great. You're accruing wealth in the background, and it's just vesting and running through your W-2. It's a system that's just building and snowballing in the background, but they never put together an exit strategy or a goal for the assets. And I cannot stress on you enough that anything you get into, you need to have an exit strategy to get out of. That's all part of the plan. So when we're looking at your overall piece of the pie, right, we're looking at all of these shares, and as they're vesting, what are the most opportunistic assets that you hold? What has the lowest cost basis? What has the highest cost basis, etc.? You have to treat it all as one entity. So one of the things that I highlight here as a bullet point is loss offsets gain. So if you have shares that you received 10 years ago and the company was trading at $50 a share when you acquired them, and it's currently trading at 100, that's a $50 per share gain. But let's say the company last year was trading at $150 per share, and now it's trading at 100. Those RSUs that you received last year that you vested would have vested with a value of approximately $150 a share. If you wanted to sell those, you'd have a $50 per share loss. When you look at a gain and a loss, you can sell something at a loss to offset something else at a gain. So in that example, if you sold the shares that had a $50 per share gain, and you sold the same number of shares that had a $50 per share loss, you would break completely even on that taxable event, right? The gain offset the loss. As long as it's a long-term capital gain and a long-term capital loss, or a short-term capital gain and a short-term capital loss, they can offset each other. So there is a strategy and an art behind taking advantage of that and making sure you're doing it properly. The last note that I'll put in here is if you need money for certain things, this is where you can build it into your goals and make sure you're taking it as efficiently as possible. So I'll use a real life scenario here. I had a client that came to me. They were an upper level executive, and their whole game plan behind these restricted stock units for all these years is just accrue, accrue, accrue. And after it's grown, they're going to use it to pay for college, right? Not a bad strategy. It's after-tax money. So when we sat down, they walked me through what they had done the semester before and said, does it make sense? So let me walk you through that, right? So they had held these restricted stock units for almost 10 years. So they own company stock. And let's say it's the ABC company. What they were doing is they were selling their oldest restricted stock units. And they were doing that because they've held them for a long time, and they said the basis is the lowest, and they just wanted to get rid of that holding. When I talked to them, I said, you're at the peak of your earning career. You're making more money now than you've ever made before, which means your tax bracket is ultimately high. I understand that it's at a capital gains rate at this point that is in your benefit because it's long-term capital gains, but the company had previously taken a dip from where it was trading at its all-time high. So they acquired the shares at, let's say, $100 per share, and the company was now trading at $85 per share. So when we sat down and looked at it, they acquired their original shares at $25 a share, and it's trading at $85. They would have a $60 per share long-term capital gain to pay taxes on to pay for school. They had shares that had just previously vested a few months prior at $100 per share, and now it's trading at $85 per share. When we looked at it, what we were able to do is actually sell the most recent RSUs that vested, and since it was trading at a loss, they had no taxes owed. They were able to take that money, instead of owing even more money to Uncle Sam on top of for paying for school, they were able to take that money out at a loss, utilize that to ultimately pay for school, and then we were able to actually liquidate some other holdings that were at a short-term gain to help offset that loss as well. So there's some strategies that we need to build into the plan, but ultimately what it does in the long term is it allows you to use the money for the goals that you have in place in the most efficient way possible. So I know I just went through this very quickly. I know there's probably a lot of questions regarding different strategies or different things around this, but ultimately I urge you to just think through an exit strategy on the restricted stock units. Think through a holistic plan. I'd love to help you do that. And if you have any questions, please reach out to us, right? We do this all the time, but ultimately, please feel free to shoot me an email or give me a call. I'm glad to go through this with you in detail. I appreciate you guys listening to this. I hope you have a great rest of your day and stay safe. Thank you.